Good morning, everyone. Thank you for joining today's Phillip Securities Research morning call. We have a few stock counter updates. For results, we have Adobe and Zixin. For Phillip on the ground, we have TopGov. And we'll also have our macro and sector outlook. For Phillip, one of it is Phillip Macro Update and also Mag7 Monthly. And we also have our Singapore REITs Monthly as well as our usual Singapore Weekly for week 26. We'll also be presenting on technical analysis for S&P 500. This is the usual disclaimer. The information provided is solely for educational purposes and should not be considered as financial advice. Without further ado, I'll hand over the time to Zi. Thanks.
Yeah, thanks, Ivan. Good morning, everyone. So the Fed concluded FOMC meeting last week. Next slide, please. Yeah, so as expected, the Fed kept the rate exchange at 3.5% to 3.75%, with unanimous of 12 to 0 votes. So the first thing that stood out was Walsh's broader review on how the Fed operates and communicates with the market. So he announced 5 task forces covering Fed communications, balance sheet policy, data usage, productivity, and inflation framework. So this task force will review how the Fed communicates with market, what data it used to assess the economic, how it thinks about inflation, and how the balance sheet should be managed. So more details are expected in coming months, and most of the work likely to conclude by year end. The most immediate change we can see is the statement was shorter, more direct, and Walsh made clear that forward guidance has been dropped. So when he was asked about what could trigger the next hike, he did not give a specific conditions. So this is quite different for Powell approach. So under Powell, market usually given some sense of what next. For example, in January FOMC, Powell said the Fed could loosen policy if tariff-related inflation started to roll over, or if the labor market start weakening. So what we can see is Walsh took a different approach. He gave much less guidance on what could trigger the next move, and he also did not submit his own dot plot as well. Moving on to the second takeaway is inflation. Walsh kept coming back to price stability. So in SCP, the Fed raised its 2026 PC inflation forecast to 3.6% from 2.7%, and core PCE to 3.3% from 2.7%. Walsh also made clear that 2% inflation target stay. He appears less concerned about whether inflation is exactly 2% or 2.3%, but he would be much more concerned if the inflation remains in the 3 or 4 range for a prolonged period. So the last takeaway is dot plot. The median Fed fund rate is now projected at 3.8% by end of 2026, which is higher than the current policy rate range of 3.5% to 3.75%. So this is why market interpret dot plot as hawkish. So there's 9 participants expect at least 1 cut, 8 expect no change, and only 1 expect a cut. But do note that Walsh himself downplayed the dot plot and did not submit his own dots. So for our outlook, we think that the Fed will stay on hold in near term, with market still pricing 1 rate cut by September. But at this stage, we do not see a stronger case for a rate hike. So we are expect for higher for longer interest rate. The yields moving forwards, and the next move will depend on how inflation and labor market data evolve over the coming months, which should provide greater clarity on the policy path ahead. Yeah, that's all from me. I will pass the times to my colleague. Thanks.
Thank you, Zi. Yep. So Adobe released a second quarter result. Strong premium uptake, a weak annualized recurring revenue gain. So the second quarter revenue and adjusted PATMI met our expectation at 50% to 51% of our financial model forecast. For the positive point, we see strengthening activity across the creative and marketing professional business segment grew 13% year-over-year, led by their Adobe Creative Cloud Pro, their bundling offerings, The creative freemium's monthly active users rose sharply, increased 70% year over year, and now has surpassed 90 million versus a 50% in the previous quarters. So it's an acceleration. So contribution is coming from the web and mobile users across Firefly, Express, Premiere, Photoshop, and Lightroom products. The generative credit usage remains strong, supported by sustained demand from video and audio features. For the other business segment, which is the document outflow and marketing, business professionals and consumers grew 16% year over year as Adobe's productivity suite, which is Acrobat, which is used for PDF, and Express, which is for fast marketing and content creation, saw about 20% yearly increase in the monthly active users. For the negative, the annualized recurring revenue is decelerating for the 10th quarter. So if we exclude the 480 million annualized recurring revenue contribution from the recent acquisition, which is SEMrush, which is a marketing arm for Adobe, the new one, the Adobe's total annualized recurring revenue for the quarter reached $26 billion, which was up by 10% year over year, and is a 10th consecutive quarter of organic annualized recurring revenue deceleration. So, but the management remains focused on expanding its freemium users rather than the monetization quickly. So we do think that this is likely to keep the annualized recurring revenue growth under pressure until premiumization becomes a priority for Adobe. For the outlook, Adobe would continue to stick to its freemium strategy, where they would prioritize traction first rather than monetization. So we expect strong monthly active user usage to continue to rise sharply together with the generative credit growth, but the annualized recurring revenue, which is the monetization metric, remains flat in the near future. While we are seeing that the full year subscription annualized recurring revenue guidance is unchanged at 10% from the previous quarter, if you compare with the previous year annualized recurring revenue growth, which is 11%, so it is a deceleration. So monetization is expected to improve as users convert after free trials and hit the paywall wall, which is the business model for premiumization. They give you free access first, but money come later. For the monetization for the full year is expected to be continue driven by the users migrating to the higher tier product, which is Cloud Adobe Cloud Pro product, which is where they bundle 20 apps together and which is priced 3 times more than the single applications. So this would help them to continue upsell and cross-sell their Firefly AI products and AI Acrobat. The other one is second monetization would be contributed by their AI products, which is their AI entry point platform, which is Firefly and also AI Acrobat for the PDF products. So currently, it's already reached $500 million annualized recurring revenue from the recent quarter, and is currently scaling toward the $1 billion annualized recurring revenue in the near term, as I said in the 2 quarters ago. But if you compare with the full year revenue, it's only about 1 million. It's only about 1%, so it's quite minor compared to the total amount. The next monetization would come from the generative credit usage, where people are using their AI models embedded into their platform, where they can also use third-party models like OpenAI, ChatGPT, and so on to their creative products. This would continue to contribute to the Adobe's add-on credit packs, which is the consumer-based monetization. For the view, we do think that the company is currently trading at a significant discount, now trading at 11 times of the full year GAAP PE, which is below the full year average of 18 times. Our target price implies a 21 times, which is a 29% discount to peers of 27 times. We believe the de-rating is driven by mostly sentiment on management departures, passion for AI-driven results, and the market rotating out into the customer with a stronger AI-led growth narrative. The recent Adobe CEO transition out and CFO departures, do you think that is less concern that the CEO transition is, it is a planned succession where the Chantanu narrator would remain as a chair even after he transition out as the CEO? In the CFO departure is an excellent opportunity for him, so mostly it's now covered by the interim basis by the finance executive. So a lot of opportunities is there, it continue to remain, but the freemium models continue to dampen the Adobe's near-term annualized recurring revenue and monetization is still early with the AI products. But we do think that Adobe will still remain resilient as a creative software provider. They provide commercially safe models and IP that protect enterprises, and also enterprises need multi-channel end-to-end creative product rather than just one marketing product tools. And they also integrate the large language models and the AI models as they are released out there integrated into the models like OpenAI, Gemini, and other proven creative works. We continue to maintain a buy recommendation with a high target price of $385. We raised our revenue estimate by 2%, but we cut our adjusted partner by 3% due to the higher than expected, general and administration expenses and income tax expenses. That is all from me. I will pass over to Glenn for the Magnificent 7 presentation. Thank you.
Hey, thanks, Fahmi. Yeah. So we just do the recap of the Mag7 in May for this year. Yeah. The next slide, please. Yeah, so for the Mag7 stocks, if we look at the performance in May, it has continued to recover. It's up 5.4% for the month. It outperformed the S&P 500, but did underperform the Nasdaq. A majority of the Mag7 counters did gain this month. So I think 6 out of the 7 Mag7 counters gained. But Tesla was the standout performer. It was buoyed by the launch of the full self-driving supervised in China, and also some growing optimism about its upcoming Austin robo-taxi rollout. Apple was the second closest, the second most, the second gainer. It was up 11.4%, mainly on resilient iPhone 17 demand and also a clearer visibility into its AI roadmap. And but with talks with now they're having the collaboration with Gemini. Microsoft, Nvidia, and Meta also did gain mainly from steady AI and also cloud momentum. Google was really the only laggard down 1.6%, weighed down by the dilution concerns from its $80 billion equity offering, which Serena will go into more detail later on when she covers Google. Yeah. So we believe that the continued recovery was driven by sustained AI and cloud momentum, as well as resilient earnings that they have shown in the first quarter. With also the tech strength broadening beyond the mega caps. This is mainly supported by stock-specific catalysts across the group. Yeah. So moving on to the next slide. You will be looking at the main talk of the US equities and also the US tech is SpaceX, right? They have completed the largest IPO in history. So I'll just have a few slides on a few key dates we're looking at, and also basically just a little bit more on SpaceX. So SpaceX listed on 12 June under the ticker SPCX, and it was priced at $135 per share. And it also closed the first day about 19% higher. And this valued the company at that time around 2.1 trillion. So the 75 billion that they have raised makes it the largest IPO in history, well ahead of the second largest, which is Saudi Aramco, which came in at 29 billion in 2019. So notably, looking at the offering, 30% was set aside for retail investors. This is quite a bit higher than the usual 5 to 10% that is set aside. So what is SpaceX's stated purpose? Is what they say is that, or what Elon Musk states is that it is to make humanity multi-planetary. So basically means to move out of Earth, right? And these businesses are structured all around this goal. They have Starlink, which is their satellite internet service, and that is the main near-term cash generator. It makes up about 75% of their FY25 revenue. And so this is helping to fund the rest of their businesses, which will be like the spaceship, and also the XAI or Grok. Yeah, so this will be the long-term engine for their Mars, Lunar, and also their next-gen Starlink missions. What are their main objectives? The key objectives here we listed in the table here. There are quite a few. I think most of it is linked to Starship, right? So they have the V3 maiden test flight, and also ship-to-ship propellant transfer. Basically, how airplanes do, some of the bigger aircrafts, they need to be refilled, right, while they're in flight. Yeah, so this is similar concept, but for spaceships, right, orbital refueling. So these are like second half 2026 and also 2026 to 2027 indicative timing. They also have Starlink, some objectives, which is to have the next generation V3 satellite deployment. And in Mars also, to have an uncrewed Starship test mission, and also to the moon, where they're looking at a crewed lunar landing. And I think the most important one, and also the one that everyone is looking out for, would be the AI or data area, because that is the one that is burning the most cash, right? You're looking at them burning upwards of $5 to $10 billion per quarter, kind of cash burn, right? And they would like to see some form of objective milestone. And the one that they gave was that they're looking at demonstrating and commercializing their orbital data centers, right? And that is where you put the data center basically in space. Yeah, and the indicative timing is medium term. So when it comes to Elon Musk, and his companies, medium term can mean a lot of things, right? It can mean anything from 5 years to 10 years, or even upwards of 10 to 15 years kind of time frame. So really a bit hard to say when they are going to get this out. Yeah, at least for their AI and data centers that is in orbit. They also have the other one, which is they want to make the semicon chips, but that's also sort of a collaboration that they have with Tesla. So next slide, please. Yeah. So some of the main key deadlines, or at least timelines we're looking at for your investor, right? Would be when are they likely to enter the major indices, and also the lockup schedule. So I'll talk about the major indices first. They're looking at the FTSE Russell, so that's 5 days. So it will be anytime very soon, late June. And the next biggest one, and I guess the most important one for now, would be the Nasdaq. That will be about 15 trading days after listing. So we're looking at around early July, so about 2 weeks time. And then the last one will be the S&P 500. So that's luckily, they didn't relax their rules for SpaceX. So they have to meet like the profitability and also the 12-month or 1 year period. So the earliest that they can enter the S&P 500 will be like mid 2027. Yeah, so these two, what it means that when it's added to the major indices, this will sort of force the passive funds to buy it, and then this will also trim existing holdings such as the Mag7. And when the locked up, so the second one that we're looking at, which is the lockup days, right, is when they become eligible for sale and they get released. This can actually add supply and also way down the price of SpaceX. Yeah, so for their lockup periods, they have a very complicated structure, but basically, the next nearest one that we're looking at would be late July, is when 20% of the locked up shares or a further 10% if SpaceX trades 30% above the offer price will be released. So this will affect the insiders and early investors who will be able to sell their shares. Right? And then the next few dates are like 70 days, 90 days, 105, 120, 185 days. So it's quite a bit staggered, right? So the bottom line is, what we believe, all these dates is that the most relevant date is the Nasdaq 100, that will be early July. And this will create some short-lived selling pressure on the Mag7 because a lot of the funds will start to rebalance. And the good thing is that at least the S&P 500 sort of limits the broader passive impact, right? Because most of the retail index exposure sits in S&P 500 trackers. And also, we don't believe that SpaceX will be a fundamental threat to the Mag7. If anything, a lot of the Mag7 are actually key suppliers and partners to SpaceX. So the effects that we will see here are mainly technical and also quite largely temporary. Yeah, so that's for SpaceX. Now moving on to the next slide, which under my coverage is Tesla. So for Tesla, 4 main key news, right? Their China sales did improve, but their market share has remained stagnant. So, it just goes to show that they are still not able to beat the larger Chinese EV market growth, right? Although it has grown, their share, their year-on-year and month-on-month growth is quite strong. So they're still losing out to the Chinese EV competitors. And then also they ended their Model S and X production. So they ended this 14-year run that they have seen. I mean, it sort of makes sense because the S Model 3 and Y did account for 97% of their delivery. So, this S and X only produces like 3%. We believe that, it signals that they are actually moving away from the premium EV segment and now trying to focus on the robotics part, which is the Optimus robot. Their CyberCab has also cleared their EPA certification, but the specs have somewhat underwhelmed, right? It's very low cost, urban focused design, so a very small battery and also only a single front wheel drive. As for the last piece of news is that FSD and Optimus expansion has continued, right? And that's the biggest, most positive news is that the FSD supervised has launched in China, and also the fleet size in China is very big. So that just goes, we are seeing some more steps towards full self-driving. Yeah, but we still remain negative, on Tesla, and we maintain our sell call and the target price of $220 as they are moving away from being a car company and now going into like a robotic company and full self-driving company, which has yet to shown, that it can actually provide any profit generation, right? So that's why we are still quite negative on Tesla. So that's all I have for my parts. I'll now hand it over to Fahmi for Microsoft. Thanks.
For Microsoft, there isn't much of a news. Only one news material that I see that there's a rumor in the market that for potential compute deal with the Anthropic. So it's reportedly in discussion for Microsoft to deploy their Microsoft Maya AI 200 chips. It's because Anthropic is seeking additional compute capacity. Although no agreement has been signed, not to date, so it's just a rumor in the market. But we do think that this deal potentially relies, as nowadays Anthropic is facing growing compute constraint, as the CEO highlighted earlier last month. And also not to mention that they saw sharp acceleration in their annualized recurring revenue, their sales. It grew to $30 billion in April, which is 3 times, and then even now accelerating, a fast-growing powerhouse for AI. So if this happen, which most likely don't think, but no one knows, could create additional cloud revenue opportunities for Microsoft, a long-term one, with another powerhouse for AI like OpenAI. They already have strong relationship with OpenAI, but now you got the Anthropic is the winning horse. It's an opportunity for them to further strengthen the existing partnership with Anthropic that they already had, as Anthropic committed would $30 billion on Microsoft NZ capacity computing, last year in November 2025. So this may bring up further the size of the deal to more than that $5 billion for Microsoft. For the share price, it rose about 10% on monthly basis. But it currently remains 20% below the peak price, which was on July last year. And we do think that this is because of higher capital expenditure concern, near-term margin pressure, and also AI disruption. But we maintain a cumulative recommendation with a target price of $485. We continue to expect a step up in the growth as the new data center ramp up, and the company would continue to be supported by $627 billion commercial revenue remaining performance obligation, which is their backlog, which is currently making half of their full year revenue. So that's all from me. I will hand over to Serena for Meta. Thank you.
Thank you, Fahmi. Good morning, everyone. I'm going to start with Alphabet. So first, the company announced a nearly $85 billion equity offering in order to finance the expansion of the AI infrastructure and computing capacity. So in this entire package, there will be a $10 billion private placement by Berkshire Hathaway. It's going to be a Class A share at a price of $351.81, and also Class C at $348.20. And the second part will be $30 billion in underwritten offering. There will be $15 billion Class A and Class C shares, The offer price will be at $355.20 and $351.80 respectively, and the remaining $15 billion will be at 6.25% of mandatory convertible preferred stocks. And the remaining $40 billion will be at the at-the-market program. So it's going to be expected to begin in the third quarter of 2026. And for this entirely equity offering, there will be no lockup period. Besides this news, Alphabet also mentions that they will have a partnership with Blackstone in order to offer a data center and also Google Cloud TPU as a service offering. So Blackstone will make the initial $5 billion equity commitment in order to bring more capacity online in 2027. But the entire plan is to scale it significantly over the period of time. So we view both moves positively, because even though share dilution might happen in the short-term basis, but over the longer period, it helps with Alphabet balance sheet. And we also think it helps to ease some of the financial burden in order to pay for the AI expansion instead of using the free cash flow. But at the same time, joint venture with Blackstone also helps to address a very important issue, which is capacity constraint, because this is the company that currently has more than $150 billion data center assets under its AI infrastructure portfolio. So once they will be able to bring more capacity online, they will be providing a more scalable monetization pathway for Google Cloud TPU. Instead of just relying on traditional cloud contracts. So this will be an additional revenue stream for Alphabet. Yeah. Moving on to Meta, some update about the mainness deal because of the restriction of the investment rule from the China regulators. So the Meta has now complete operation split from mainness, and it stopped the data sharing between these two companies. So Meta has barred mainness and the staff from accessing the US company internal data system. And at the same time, Meta employee can also no longer to use mainness tool for internal projects. So and also beside the setback from this acquisition, the company also announced that they delay multiple times in order to release the new AI model, which is MuseSpark AI Developer API, because of the ongoing bugs, and also there is an infrastructure issue. But Meta says that it's now testing the API with some partners, and they look forward to release it in June 2026. So we believe the operational unwinding of mainness remove a very important catalyst for agentic workflow development, because that was the initial plan of why this acquisition will happen, because this is what mainness expertise in, which is agentic AI. And therefore, unwinding this acquisition will actually increase some of the burden and reliance of Meta Superintelligence lab in terms of the reliance on the in-house framework. That's why we will expect more market concern around the CapEx, because at the moment, if you look at the entire AI model landscape, for Meta, is still a bit lagging behind the competitors. So therefore, we think that the next launch of this AI model will be a key catalyst for the investor to reset expectation and to see whether there is an improved confidence in this Meta longer term monetization strategy. Yeah. And that's all from me. I'll pass the time to Helena for Amazon. Thanks.
Thank you, Serena. I'll continue for Amazon. So Amazon continued to invest in their data center. The most recent one they announced is the multi-billion-dollar data center in Missouri. Other than that, their custom chip is gaining a lot of traction. Their Graviton 5 is now generally available and delivers up to 25% higher compute performance compared to their previous generation. Adoption also gaining momentum. Snowflake recently committed to purchase $6 billion of Graviton-based compute and AI service on AWS over the next 5 years. At the same time, their Trainian AI accelerator is also gaining traction because of their very attractive cost performance. On the e-commerce side, they're expanding their same-day and ultra-fast deliveries, extending this 30-minute delivery service from 4 initial cities to 8 additional US market. They're also expanding the same-day grocery delivery to over 2,300 cities and towns. So overall, everything is going in good direction for all their businesses. We think the really spotlight is how their Graviton and Trainia has been gaining traction, and this not only helps them to win outside customers, it also helps to reduce AWS in-house infrastructure costs by billions of dollars annually. So that reinforces Amazon's position as the AI beneficiary. So overall, we're pretty optimistic on Amazon. We have accumulated rating with a target price of $280. Moving on to the next, which is Apple. So Apple recently announced they've extended the private cloud compute through collaboration with Google and NVIDIA. So part of the Apple intelligence, when the workload is too high, it will be running on Google Cloud AI infrastructure supported by NVIDIA's GPU. So this follows their earlier collaboration with Google to use Gemini model to develop their next generation Apple model. Another one is they face a rejection from the EU regulators on their Siri AI exemption request. So Siri AI would not be launched in Europe initially due to these regulatory constraints. Apple has actually proposed a 18 months implementation plan that could introduce the intermediary layer to enable a third-party virtual assistant to interact securely with the Siri AI, but EU regulator rejected that proposal. On top of that, they had WWDC this month. It's providing more visibility into their AI strategy. They've expanded their Apple intelligence across the ecosystem and introduced a more capable Siri. In the China market, they've also cut iPhone 17 price ahead of the 618 shopping holiday. They introduced promotion discount of up to 1,000 RMB on certain models through channels like JD.com and Taobao. If you include trading subsidiaries and other incentives, the effective purchasing price for iPhone 17 Pro declined to 6,999 RMB. We think that reflects their continued effort to stimulate demand in a very highly competitive market for them, which is the China smartphone market. So to look at it as a whole, we think the near-term outlook remains largely driven by their hardware demand, which has been seeing a very fruitful season for them. This also benefited from the delayed launch of the Samsung's Galaxy S26 lineup, which is considered a direct competitor to them in the premium segment. And also because of the rising price of the memory, Apple as a big company, they have a lot of inventory in place. So that also helps giving them a little bit of price advantage. But in the short term, we have yet to see enough evidence that AI features are significantly accelerating their device upgrade. So it really depends on whether they have a successful execution and user adoption of AI intelligence in the long run. And meanwhile, because of the regulatory pressure that they face, both in Europe and also in China, that also remains an overhang on the stock. So overall, we're still very cautious on Apple. We have a target price of $290. Now I'll pass my time to Iqbal. Thanks.
Yeah, thanks, Helena. I'll be presenting on NVIDIA. So in the recent GTC Taipei 2026, NVIDIA announced that the Vera Rubin GPU are in full production. This is a new information as in their most recent earnings call, they only mentioned that Vera Rubin GPUs are ready to ship in third quarter this year. So I guess saying that the GPU are in full production will give investors more color and more confidence in the supply progress. And they also mentioned that the Vera CPUs can deliver up to 1.8 times better performance in terms of faster task completion as compared to Intel's x86 CPUs. And I guess the key highlight from May was NVIDIA's results. So NVIDIA broke down their data center into hyperscalers and ACIE, which is the AI Cloud Industrial and Enterprise. And currently, the main driver is still from hyperscalers' contribution to data center, which spiked 115% year on year. For the ACIE segment, it increased by 74% year on year. We do think that this segment will be their next growth driver because we think that NVIDIA NVIDIA segregated these two segments within data center revenue because they are anticipating a spurt in growth in terms of this ACIE segment. So what this segment consists of is basically the few 100,000 enterprises worldwide that haven't really, I mean, it's starting to adopt AI compute within their companies, as well as the industrial players which will adopt AI in the physical AI era, which is coming up next after this agentic AI era. So that's our comments for NVIDIA. We do see sovereign and enterprises AI demand to drive this next, this data center ACIE revenue segment above the hyperscalers CapEx guidance for this year, which is about 90% year-on-year growth. And this can also be seen from Nebius and CoreWeave's combined CapEx guidance this year, which is expected to surge almost 300% year-on-year to $80 billion. Because Nebius and CoreWeave will service sovereign nations as well as enterprises AI cloud demand. So we do think that this is an indication that the NVIDIA's ACIE segment will drive further growth, going forward. So NVIDIA, we maintain a buy, and we also raised our, it was raised previously to 285. So overall for Mag7, we are seeing a recovery in the Mag7 being led by AI infrastructure. For example, NVIDIA, Microsoft, Amazon, and Google. Whereas for Meta, Apple, and Tesla, they are facing more idiosyncratic headwinds. That means it's more specific to the stock itself. And SpaceX record June IPO, we think that it poses only limited short-term rebalancing risk for Mag7. Going forward, we are still positive. For valuations wise, we are seeing valuations expansion. We think that Mag7's strong balance sheet as well as free cash flow will insulate them from cost pressures. And we also think that AI monetization and resilient cloud demand will drive above market earnings growth. So we maintain overweight on Mag7. We think that its performance will continue to outpace the S&P 500 and Nasdaq. So that's all for Mag7. I'll hand over the time to Serena. Thanks.
Hi, thanks, Iqbal. So sorry about the noise. Good morning, once again. I'll be presenting Zixin second half 26 result. Next slide, please. So the result exceeded our expectation because the revenue up 44.3% year-on-year to 386.8 million renminbi, and net income increased 29.9% year-on-year to 45.4 million renminbi. This is driven by the higher sales volume in both fresh sweet potato and processed product segment. So the financial year 26 revenue partly were at 104% and 123% of our forecast. So moving to the positive, Zixin fresh sweet potato segment deliver a very strong performance because the earnings nearly double. This is driven by around 30% growth in sales volume because the company continue to utilize the smart warehouse infrastructure. So there will be lesser spoilage, and at the same time there will be more inventory to be directed into the sales channel in order to generate into a revenue. And moving forward, Zixin expect the margin in this segment will be under a little bit of pressure because of the higher production costs, including the fertilizer. But they do expect the sales growth from both China and international market to offset the headwinds, and expect the margin to maintain at the current level, which is around 21.5%. So for financial year 27, we expect the revenue in this segment to grow around 60% year-on-year. It's driven by more sales channel within China and international markets. As for the processed product, the segment reported a 12.5% year-on-year earnings growth, mostly driven by the sales of sweet potato chips and also steamed sweet potato. This portfolio sales actually surged 71% year-on-year. in the second half of 26. So for financial 27, we do expect this segment to continue to grow around 30% year on year. It's driven by the improved production of high margin premium products. And the second one is because it will be an increasing number of white label customers in ODM for specific products such as sweet potato chips. As for the negative, Zixin gross margin declined 330 basis point to 31.2% in second half because of the lower margin in fresh sweet potato segment. As at the moment, internal production has not yet so far fulfilling all the demand. So despite a very strong harvest, so they do have to procure it from the external farmers, but the procurement prices continue to grow at around 6%, and of this procurement from the external parties are subject to taxes. And if you consider the volume they have to take it, so it is a big amount of taxes they have to pay it. Therefore, there is some of the margin compression. But for Zixin, we maintain a buy recommendation and we increase our target price to 6 cents as we roll into a new financial year. So moving to financial 27, we expect the earnings to grow 24% year on year. And we think there are four main drivers. The first one, we think that there will be a continued strong demand in processed sweet potato because of the increasing number of white label customers, like I mentioned before, in China and both international markets. So alongside with the company will have a shift towards a high margin offering product like sweet potato powder because it can be used into a food supplement. And we think that the shift is a main driver because currently one of the Zixin factory is still underutilized. It's around like 40% utilization, so it leaves more room for ramp up. And the second one will be we think there will be a sustained demand for premium sweet potato varieties because they are able to maintain the similar quality like Japanese sweet potato, but with a competitive pricing. And the third one will be incremental revenue contribution from the trading activity in Hainan projects, and also continued regional sales in Southeast Asia like Singapore, Indonesia, and also Malaysia. And the last one will be the volume-driven expansion in the animal feed segment as well. So yeah, and that's all from me. I'll pass the time to Darren for REITs Monthly. Thanks.
Yeah, thanks, Serena. Yeah, I'll run through the REITs Monthly. Yeah, so our title is Weathering Interest Rate Headwinds. Yeah, so if you did not know, the ECB and Bank of Japan, they raised rates by 25 basis points in June. So this is after the Fed kind of signal that they're going to hold. Yeah, so this is the share price performance for the month of May. So we see the 1 month performance, most of the REIT subsectors were down except for overseas retail, which is just up slightly. But overall, for the year to date, it's still down 6.6%. Yeah, the 1 month, the whole REIT index is down 1.6%. Yeah, next slide, please. Yeah, so this chart is the dividend yield spread. So we see this dividend yield spread is basically the REITs dividend yield minus the MAS government 10-year bond yield. So this is in other words, you can see it as how much investors are being compensated by investing in REITs over the risk-free rate, or you also call your fixed deposit rate. So now we see it trend above the historical average, which is expected because of the share price performance, as well as the fact that the dividend yield is expected to continue to increase. So this year we are forecasting about a 3% DPU growth on average across all REITs. Yeah, so that's mainly from strong operating performance, as a lot of the REITs, they have a base escalation of about 1 to 3%, base rental escalation, as well as positive rent reversions. And also the fact that year-on-year interest cost is still lower, like the 3-month SORA is over 100 basis points lower year-on-year. And the Fed funds rate is also lower year-on-year. So we are still expecting lower interest rates for at least stable or lower interest rates for at least 80% of the REITs. Yeah, so we take a look here. 3 months SORA really remains the key driver. So it's now at 1.06. It increased slightly to 1.08. So the last I checked. So it's still at very low levels and 100 basis points lower year on year. So especially those REITs with SGD denominated debt and that are due for refinancing, so they will really benefit from this low SORA. Yeah, next slide, please. Yeah, so take a look at this forward dividend yield. Like I mentioned, we do expect this to increase, especially since we are expecting DPU growth. So if assuming share prices remain stable or constant, and with increasing DPU, the forward dividend yield will increase. And for the S-REITs index price to NAV, now we see it trading at around 1 times below or minus 1 time standard deviation. So usually, historically, like 2016 and 2020, we see when the REIT index trades at a price to NAV of around 0.9 times price to, sorry, excuse me, 0.9 times price to NAV, we see a rebound. So that is barring the 2023 to 2025 where there was a sharp rate hike cycle. Yeah, other than that, around 0.9 times price to NAV, we see a rebound. So we think this possibly could be a similar situation, despite the fact that interest rates potentially are rising globally. Yeah, but the base case is Singapore still the interest rates still remain low. So we still do expect DPU growth from that. Yeah, next slide, please. So moving on to some of the subsectors. So we see here retail sales has been really strong. So it's 4.5% up in the month of April. So it's been trending up. So tenant sales are also equally stable or equally strong, around 3 to 5% tenant sales growth. So as a result, landlords, they have the potential to raise rents as occupancy costs are still stable and there's limited supply, and tenant sales and footfall are still strong and growing. So as a result, we still favor the retail subsector. We do expect only a limited impact from the RTS, like we mentioned before. Yeah, mainly because we think those who spend in JB are already doing so, and the incremental amount of people who would go to JB to spend just because of the RTS, we don't think that will be significant. And also, it's a two-way thing. Singaporeans can go to JB easier, and Malaysians also can come to Singapore. But obviously, Malaysians, they won't spend on much, probably just F&B, but that will also help with the retail sales. Yeah, next slide, please. Yeah, so for hospitality sector, we saw in May itself, the visitor arrivals was down almost 10%, so that was a huge decline. Year to date, visitor arrivals was down 1.2%. So that was basically under the original expectations of the fact that the visitor arrivals will return to pre-COVID levels by this year. So we're still trailing behind or lagging behind that. But one thing to know is that the hotel RevPAR year to date, which is until April, Jan to April, is up about 4.5%. So we still think hotel RevPAR will trend towards the low single digits for the full year 2026, but visitor arrivals might be impacted, might still lag behind, mainly from the fact that of global uncertainties like the Iran war and higher oil prices as well, and higher airfares. Yeah, so this increase in RevPAR mainly was driven by the increase in room rates, which was up about 2.6% in April year on year. Yep, so hospitality in Singapore and especially worldwide might still remain quite challenged because of higher airfares and lower demand. Yeah, next slide, please. So now we move on to some of our topics. Yeah, so for Stoneweg, despite the fact that the ECB recently just raised rates by 25 basis points, we still expect the cost of debt to remain below 4%. So first quarter 2026 is at 3.84. So it will likely just inch up slightly, but still remain below 4% as 87% of their debt hedged through late 2027. So the key selling point for Stoneweg is their Ionics, which is the sponsor's data center development platform. So that platform, they will provide a potential fair value uplift especially when development milestones are achieved as they lease out the property, as they build up the data centers. And that, as they book in the fair value gains, basically that will reduce gearing and create additional debt headroom for them to pursue further accretive acquisitions and redevelopment opportunities. Yeah, so they are still trading at a cheap discount, or rather, they are still trading at a 5% discount on NAV. And while we wait for this upside from this Ionics data center development platform, we are getting the investors will get an attractive 8.6% dividend yield. So we think that is extremely attractive. And for Prime US REIT, the Prime US REIT is basically trading at 0.3 times price to NAV. So that is a significant discount. So for their operations, their portfolio occupancy has been improving over the last few quarters. So last year it was at 78.9, so now it's at 83.1. So it's expected to increase further by the end of this year. So by end of this year, we are expecting at least a 85% occupancy. And on top of that, about 11% of their occupancy has yet to commence cash contribution. So once this starts to contribute over time, we expect the distributable income to increase by 30% next year. So that will help to increase the DPU as well. However, one thing is that the all-in interest cost is expected to increase to 6%. So that's expected to increase from 5.4% to about 6% for the full year of 2026. And that the potential Fed rate hikes also would cause some additional pressures to this interest rate. Yeah, but generally, because of the fact that 11% of occupancy at the commence cash, so what that means is only about 72% of their occupancy is contributing cash at the moment. So once this comes in, the cash contributions will ramp up, and the DPU growth potential will be much higher. So now they are paying a 65% payout ratio, so that when that increases as well, the dividend will increase. So currently, the yield this year, we're expecting about a 7.3% yield. So that is also attractive while we wait for this recovery. And for the next, we have United Hampshire. So that this is a very stable play. So because of that, it's still expected to decline. So we did some sensitivity, like if the Fed increases rates by 25 basis points, the DPU impacted by 0.7%. So that is a small impact. But of course, there is an impact for that, because 70% of that debt is hedged. But for their operations, it's very resilient. So they have high grocery and necessity occupancy of almost 98%. They still have long WALE and have limited leases that are due for refinancing or expiring. So that's only about 7% over the next 2 years. So very resilient, and they do have inbuilt rental escalations as well. So that is attractive for us, and they are also trading at an attractive 8.6% yield. Yeah, we also have another pick, which is not in the slide, which is basically Elite. So Elite, they recently announced that they will acquire 5 UK government leased properties for about 32 million pounds. So that is expected to be about 1.3% DPU accretive. And they also announced the redevelopment of Lindsay House into a 170-bed PBSA asset. So they recently did a private placement to raise about 7 million. So that was priced at 0.296 pounds. Yeah, so that was to fund the acquisition as well as the redevelopment of the PBSA asset. So we view this transaction positively, as it basically extends the portfolio WALE from about 6.9 years to about 7.6 years. And it also adds a new tenant, which is the HM Revenue and Customs. And that is a government-backed tenant, and it also further enhances income resilience. So Elite is trading at an attractive yield at 9% at the moment. Yeah. Next slide, please. Yeah, so this is the rest of our coverage. Yeah, so for us, at this point in time, we favor those REITs with a higher dividend yield. So mostly these overseas REITs where they're trading at about over 8% yield. So we think that's attractive in this current environment. Yeah, I'll hand over time now to Zane for the technicals. Thanks.
Yeah, thanks, Darren. Good morning, everyone. I'll move on to the technicals. So, taking a look at the S&P 500 last week, price is still holding the really 10 SME level, so that's about 7,369 of Thursday, and the gap fill at 7,400 7,456 is also holding support. So overall, last week was up 0.9%. I think for this week, we are likely to see some sort of a sideways consolidation continue, with general resistance at 7,560, which was around the swing highs of the start of last week, to about 7,620, which was the all-time highs. Support likely to hold, I think, at 7,400 to about 7,470 area. Yeah, so that's all from me. I'll hand the time to Iqbal, who will be covering for things.
Yeah, thanks, Zay. Paul is currently at another meeting, so I'll be covering the Singapore weekly. Yeah, so this is some of the macro data out for the past week. There's quite a lot of data. Firstly, for visitor arrivals is quite lackluster, as what Darren mentioned, down 9%, down 10% year on year in May. For new launch wise, it is robust in May, but if we look at the year to date for 2026, it's still sort of flat. We are expecting about 9,000 units for this year itself. So year to date is about 4,000 units. So it's still in line with our expectations. For China, data wise, is quite soft. In terms of loans growth, even though it is up 5.5% year on year in May, it is at a decelerating trend since for the past 6 years after COVID. So also for their residential space sold and residential space completed, year to date is also down 13% and 25% respectively. Regarding this, we still see China's property market contracting, and the property sales data, the property space sold data is important, the one that is down 13% year on year, because it can also impact other industries. For example, if there is a recovery in residential space sold, it can also spur up construction sector, the electronic sector, and the furniture industry in China. So currently, we are still seeing it declining 13% year on year, and we expect this to be a drag to the economy. In terms of retail sales in the US, it is exceptionally strong. If we exclude gasoline, it is up about 6% year on year. So we are still seeing robust consumer spending. Yeah. In terms of our tactical views, yeah, as what Zhi mentioned regarding the new Fed chair, his key mantra is that inflation is a choice. So even though there may be external shocks to the inflation, his key mantra is that the Fed must stop the spiraling in the US and not blame it on transitory external shocks. For his preferred gauge to measure inflation, he prefers trim mean PCE. So this removes the smallest and the largest extreme movements in terms of the PCE inflation data, and he thinks that this is a better gauge of the inflation in the US. In terms of the change in communication, he also removed forward guidance. So I think this will increase the flexibility for the Fed to change policy as data changes, and they also prefer to use interest rate and not balance sheet as a fair gauge of the economy. So our conclusion is that overall we do not expect rate hikes this year, and because the trim mean PCE inflation is at 2% for the past 22 months, so it has already reached that target. And yeah, so generally we are seeing we don't expect a rate hike this year. Yeah. In terms of the weeks ahead, for this week we are seeing Micron result coming out, as well as the US PCE inflation data, and these are the corporate insight webinars coming out early July next month. Yeah, LHN and IX Biopharma. Yeah, so this is some of the key data. For this slide, it shows the China. It shows the data coming from China. So the chart on the left shows the liquidity conditions. As you can see, the loans growth has been decelerating for the past 6 years, even though it is still in positive territory. But we are seeing a lot of deleveraging. The net amount of loans injected into the economy has been coming down, And for the chart on the right, we still see that the residential space sold continue to contract. Yeah, so we still think that the Chinese economy continues to be soft. Yeah, especially for properties. In terms of the Chinese, this one is also for China itself. Their China retail sales, consumer re, consumer retail sales is also trending down. As seen in the data on the left-hand side. In terms of the fixed asset investments, this is a bit of a gauge for the corporate spending. It's also trending down. So it turned negative for the first time since the pandemic. Yeah, so overall for Chinese economy is still soft. Yeah, so over here it shows the US macro data. The chart on the left shows the US retail sales. It has accelerated for the past few months. And corporate spending, we are also seeing an acceleration in corporate spending because of the AI investments. The chart on the right shows retail inventories. So it has not climbed up much despite the war going on. So this is good for Asian exporters to the US. The charts here show the rate hike charts. For the chart on the left, it shows the US Fed rates against the 2-year bond, so as the core PC data. As you can see in the green color line, market is expecting one rate hike for this year itself. For 2027, they are still not expecting any hikes. So, however, for for 2026 itself, we are still not expecting any rate hikes because of the reasons mentioned earlier. As for the chart on the right, the red color line shows the trim mean inflation gauge that the Fed measures. So basically, they take out the extreme data points, and currently, it is within the 2%. It is within their 2% target. So we don't think that there will be a interest rate hike this year. Yeah, so this is the last slide. I'll be presenting Phillip on the ground for Top Growth on behalf of Paul as well. Yeah, so in terms of their earnings, they recorded strong results for this quarter, the quarter 26. It is up 111% year on year. So I think there are some worries regarding Top Growth's ASP. It has come down slightly, and gas prices has also jumped by about 40% year on year. But however, we still think that the fourth quarter, which is the next quarter, Top Growth will be able to record strong numbers. For example, we think that their EBITDA margin will be able to reach about 15% as compared to last year's 13%. This is because raw material prices are coming down for Top Growth. And we also think that the weakening ringgit should be positive for Top Growth as well. As you can see at the chart at the bottom right-hand corner, we think that the rising utilization can be a sign of, can be an indicator for pricing power. So we think that this will be positive for their margins. As for the raw materials prices coming down, we also think that Riverstone will be a major beneficiary, especially when the raw material and FX is coming down. Yeah. So that's the Phillip on the ground for Top Growth. I think we can move on to the Q&A. Yeah, thanks.
Okay, let me take on some of the, thanks, Ivan. Let me take on some of the Q&A first, before we pass on to the rest. Let me just try to find the one that is for me. I think got a few on SpaceX. Yeah, why is the TAM for XAI so big? Yeah, so TAM is total addressable market. Yeah, why is it so big? It's because it's Elon Musk. No, I'm just joking. Yeah, it's really because they look at a lot of things. Yeah, I think I said this last week, is that SpaceX isn't, or like XAI, they don't just look at AI market. They don't just look at the space market. They look at a lot of different things. So they look at the AI market, they look at the space market, they look at the Twitter, right, or X market, they look at even Tesla's market. Yeah, and they look at the spaceship, robotics, Wi-Fi, data center market. So everything is really just thrown into this TAM. So I think what's more important is not the TAM, but it's what is the likelihood of them capturing it. And of course, they won't say it, right? They won't be like, oh, the TAM is however much, but the possibility of us capturing it is maybe only 5% or 10%, right? Then it will lower the opportunity, it lowers their guidance and forecast, right, of all the analysts. So that's the key missing factor that we're looking at. So they can say whatever TAM they want, but the opportunity and the likelihood of even capturing however many percent of this is up to anyone's guess. Yeah. So quite expected from Elon Musk, I guess. When you're looking at how he did what he did with Tesla, you sort of expect it with, or even at a greater scale with SpaceX and XAI and everything. Yeah. So just to take it with a pinch of salt, that the TAM, especially for SpaceX. It's literally the whole world if you think of it. Every single thing can be under XAI. Yeah, okay, why didn't SpaceX go up after the FTSE funds bought in the 5 trading days one? Yeah, very good question. Why we didn't go up mainly because it's already priced in. The FTSE Russell is also quite small, as compared to Nasdaq or the S&P 500. Some sellers might also be, trying to take profit, right? So they are also selling. And I think the one that is really the bigger flow event would be the Nasdaq, which is coming in about a week's or 2 weeks time. Yeah. So that is the main one that we'll be looking at. Yeah, so it's rather small. This is like the precursor to the entree, right? It's like the appetizer. Then maybe the main dish or dessert will be the S&P 500, which you have to wait 1 year for it. Yeah. Yeah, will the higher for longer interest rates have similar or different impact on the Singapore and US banks? Yeah, I think it will have similar also, but also different. Similarities wise is that they are both very rate sensitive, both the Singapore and US banks, and that the higher the rates, of course, the better. Difference in the sense that the Singapore banks are more rate sensitive than the US banks because they are less diversified. Most of their revenue and income is from net interest, from margin sensitive net interest income, right? So that's where the difference lies. So the higher for longer rates will be more beneficial for the Singapore banks. As for the US banks, competition is higher, so it will force deposits pricing to go down. So if rates go up, they might not creep up as fast as in Singapore. And also they are a bit more diversified, right? In terms of the mega cap banks. Look at JP Morgan, a lot of their business is diversified across wealth management, fee income, and also investment banking. Right? A lot of that is really spread out, and that's the biggest bank in America. So yeah, I think it affects the US banks a bit lesser than the Singapore banks. Yeah, one more about this SpaceX again is asking about the Cursor acquisition. Yeah, so they did 60 billion for this acquisition, and so they acquired Anysphere, which is the startup behind the AI coding tool Cursor that you're mentioning here. So they did about 60 billion in stock, right? Not in cash. So the good thing is that it didn't affect the 75 billion that they got from the IPO, right? It's really an AI play because Cursor helps the developers generate, edit, and also review code. And it really underscores the huge demand that they have for AI-based coding, right? So the fact that SpaceX has enveloped XAI and also Grok into it. So this is really meant to give like an inorganic growth spurt or growth, right? Like a sort of addition to that Grok AI business. And I think it really looks at SpaceX now as an AI player, or it might even be a bit of a semicon player as well, because they want to build the TerraFab right? So not sure so much how is it anymore a space company. Yeah, as it was maybe 5 years ago, right, when it was purely a space play or satellite play, but now it looks like it's just another AI company. Yeah, so all of that is again, you must be a bit careful because yeah, they did acquire this, so they're already going all in onto AI, the AI race. But keep in mind that they are fighting with Anthropic and all the big players, Anthropic, ChatGPT, Gemini. Yeah, so and now with Anthropic and ChatGPT going to OpenAI that is going to also IPO soon, right? So it's a bit of the competition is just getting more and more intensified. Yeah, the competition is getting very, 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 very fierce now in this AI space. So whether or not the question is they are trying to enter a space that is really overcrowded. I think a few more. Yeah, SGX outlook. Yeah, so SGX, I think a few things did drive the all-time high. They had very, very good volumes in May. I think I talked about it in my banking Monday last week. They're also seeing a revived, or maybe not yet revived, halfway revived IPO and listings pipeline. So, and last but not least, you're looking at that above 6 billion EQDP that the government has pumped in, which will just help to grow it even more. Yeah, so all this is really boosting the SGX share price. But you look at the what it's trading at, right? It's almost 40 times PE. Right? So I think a lot of this good news and has been really priced in. The main drivers are still the same, right? Really volume-driven growth, and also the upsides wise, maybe SGX, if MAS pumps in more money, that could be a big upside. But I think a lot of it is priced in already into SGX. Yeah, we don't really have a new TP. When we have one, we will give it. Yeah, my TP is a bit lower than the current price now. So when we have a new one, we will definitely update everybody. Yeah, what's driving the banks and new highs recently? I think that the fact that the Fed chair has changed, and also now we're looking at not just higher for longer, but even there might be some uptick in like what Zui has mentioned. There might be some rate hikes, right? Would be very positive for the banks, right? And that was the main thing that is driving the banks to new highs. And also like in terms of volatility, a lot of people would like to go into stable stocks, right? That pay high dividends and stable dividends. So the banks tick that boxes for a lot of investors, not just retail, but also institutional, where you're looking at something more stable. So I think the banks, that's what drove the banks. And on top of that, you have this environment that is very beneficial for the banks, right? Volatility is also pretty high, so it benefits their fee income, trading income. And then, you have higher for longer rates or even some form of rate hikes, right? Then you're looking at benefiting the net interest income as well. So, all these are like just basically good base cases for the banks. Yeah, one more on the banks asking why UOB has played catch up. And whether we have any new TP. No, we don't have any new TP. We're still neutral on UOB. I think our target price now is $39. So we don't have any new TP for UOB. Firstly, what drove UOB is I think the DBS and OCBC has reached all-time high before them. So the valuations are a bit high. So I think anybody who wants to buy into a bank now, if you feel like the three banks are quite similar, then you would get the cheapest one, which is UOB at that point of time. Also the credit cost story that they lagged behind, and why a lot of people sold UOB stocks about half a year ago, right? This is the provisioning that they had. I think coming this year, in the first quarter, we did see some normalization, and also the management has been trying to push on saying that it's normalizing, and we don't expect any more higher provisions. So that helped them also. But why we don't believe that we didn't give a new higher TP or have a better call than neutral is because if you look at UOB, we haven't seen their fee income turning around yet, right? Whatever they are putting in, the effort they're putting into the ASEAN growth, from the city assets hasn't paid off yet, right? You're seeing even a decline in wealth management fee income. Whereas the other two banks are seeing like almost double-digit growth. Right? And then UOB here is, giving either very small percentage or even a decline in fee income growth. So that's the one that's really holding us back. Yeah, from UOB. I think that's all for me. Let me just take a quick look again. Yeah, it's asking about more about Great Eastern and OCBC. Yeah, we don't cover Great Eastern, so a bit hard lah. But for us, I think OCBC is better because it's you're basically buying Great Eastern as well, but you're buying a bank also, so you get the benefit both. Yeah, and OCBC owns like 90% of Great Eastern lah. So okay, I think that's all for me. I hand over to the rest of my colleagues. Thanks.
Thank you, Glenn. I guess I'll take over. So there are some questions with regard to Intel and Apple. So I think Iqbal is probably in better position to answer that, but I'm just offering my 2 cents. I think definitely the collaboration with Apple helps, but it acted more like a catalyst instead of a fundamental reason. So the more fundamental reason that Intel has been rallying recently is because the US, they obviously want a domestic semicon manufacturing. And customers, they wanted a second source beside TSMC. And obviously the AI demand coming in is creating a huge, enormous capacity need. So it's understandable that the US government is highly motivated to ensure that Intel succeed. And because there's no other US owned alternative that they have, so they actually have to show their support. And if I remember right, they're having an equity investment. So now it makes the US government its largest shareholder. Might be wrong. But basically, yeah, they invested in Intel. So for them, it's too strategic to fail if you think about the US government backing it. So the collaboration with Apple, it's like a catalyst because people are already having a lot of confidence from the US government support. So if Apple decided to collaborate with them, then other customers are definitely more likely to trust Intel as well. And also Apple is already one of the world's most demanding semiconductor customers. But I think so far neither Apple nor Intel has publicly confirmed all the details. And even if there is volume production, it is likely going to be years away. But yeah, that is basically why it rallied. I'm gonna leave the question here just in case Iqbal wanted to add on to it. And then I remember I saw a question on Netflix. Yeah, why has Netflix stock underperformed so much? Honestly, there's nothing wrong with Netflix business. The business is doing just fine. They're able to come up with a very strong content slate. They're adding subscribers. Their earning power is increasing. They've recently adjusted their price up again, and they're not really losing subscribers. So that means they still have very strong pricing power. But I guess the problem is that the stock is already pricing a lot of the good news. So if we really have to say why it underperformed, I think one of the reason is for their most recent earnings, the guidance was a little bit below expectation. They also didn't really increase their full year guidance. I was it's not bad, but just the market is interpreting it as a sign that growth might be slowing down. So it's like good result, but not better. So for a company trading a very high premium, probably the market doesn't really appreciate it so much. And I think the long-term concern that Netflix probably going to have, because previously they're always worried about, competitors, competition in the same industry, but they're becoming more and more of a clear leader in the industry. So not much so. I think now the problem to me for them in the long term is probably because every people have very limited screen time each day. And now users, especially young users, they're increasingly using a lot of their entertainment hours on content, like user generated content, instead of premium TV. So like TikTok and YouTube. At least I find myself, because previously when I got nothing to do, I probably turn on the TV and watch something. But now there's a lot of time I'm just finding myself swiping on TikTok. So that is probably one of the concerns that they may have in the long term. And another reason is, of course, because now the market is focused so much on being the AI winner, because they are not considered an AI winner because they don't really have a direct AI monetization narrative. So yeah, that's probably why. So I hope that answers your question. I guess that's pretty much I have a few Amazon. How is Amazon's AI strategy contributing to revenue, particularly in AWS, and what is their monetization plan, and how do they plan to compete with Microsoft and Google in the AI space, and how do you see the competitive landscape evolving in the next 12 to 18 months? So right now, their revenue is driven primarily by their AI infrastructure, their GPU, Trainium network, and storage. So like I mentioned just now, their GPU and GPU, CPU has actually grown quite a lot. So they're now considered a top 3 data center chip company, commercial company. So previously, it's probably NVIDIA, Intel, and AMD. Now it's NVIDIA, Intel, and AWS because their customer silicon business already surpassed roughly $20 billion annual revenue run rate. So that makes it larger than a lot of the standalone semiconductor company. So that is also where they're trying to monetize, and it's also helping to save their own costs and making them more competitive in cost wise. And I think another important thing that differs them from Microsoft and Google is Amazon right now for their Bedrock. They don't really have a dominant frontier model that they're trying to push. So it's really like a model neutral approach through their Bedrock. So I guess that is a smart way. So if the AI leader changes from Cloud to ChatGPT to Gemini, they don't need to rebuild their entire architecture to fit into the change. I think that is the awkward situation that Microsoft is in right now because they're highly tied up with OpenAI, and now with OpenAI trying to gain independence, and they're collaborating with other companies like Amazon. So it's a little bit tricky spot for Microsoft. But if Amazon has always been model neutral, that makes them easier to navigate themselves in case the situation change in the future. And in terms of the next 12 to 18 months, I would say the entire cloud industry is still in the very beginning. So it is not really about competing with each other because there's more than enough demand for everybody. So it's just so the way I see it, it's just going to be high growth for all the cloud players in the market. So yeah, maybe the Microsoft and Google side, the other analysts can also chip in. I think that's all from me. I'll pass my time to my colleagues. Thank you.
Yeah, thanks, Helena. Yeah, so just to add on to, okay, never mind, I just take on the questions. What to expect from Micron results this week? Yeah, so I think based on the commentary from its competitors, SK Hynix and Samsung, there's still a lack of clean room space. There's still supply constraints in memory chips, high bandwidth memory as well as NAND. And they are also signing longer term agreements with their customers as compared to previously. So I think in terms of the results wise, it will be good. I think it will be above 100% year-on-year growth for both revenue and PATMI. But it's just about their guidance. I think investors will look at how many long-term agreements are they signing with their customers and trying to see if there is a structural change in terms of this memory cyclicality. Yeah, because with higher demand for data center, investors are looking whether this demand for memory chips are actually structural, whether there's a structural increase rather than a cyclical kind of cycles like the past. Yeah. So for investors for the share price to go up even more, I think investors are looking at more long-term agreements being signed for Micron and its clients. Yeah. Why Intel rally last week? Yeah, I think Helena mentioned it's the news with Apple. There's a follow-up. Wait, never mind. Have you met Victims Global before? They're in the construction sector and they signed a contract this morning. Yeah, so we met them last year before. They are the top 3 demolition companies in Singapore. So demolition basically means, for example, if they want to build a building on a piece of land itself, because Singapore is land scarce. So they will have to demolish the current building and then build before they can build on top of the land itself. So the kind of contracts that Reclaims Global secures is mainly from HDB BTOs. Also because MOE is consolidating the JCs together. So they will demolish some of the old JCs that are not being used. There's also earthworks for coastal protection over the next 1 to 2 years. Yeah, so basically they have to remove the soft soil and then put the hard rocks to build the concrete walls for coastal protection. So this is the kind of drivers going forward for Reclaims Global. Yeah. And their order book last year, okay, so this is an outdated figure, it's about 20 million. Is their contract term is shorter term, about 6 to 9 months. Yeah, so we can see a kind of we may be able to see quite a stable contract flow for Reclaims Global, especially with demand coming from HDB BTOs. Yeah. There's a follow-up question on Intel. Intel rally because of the Apple thingy announcement. Would by its own Intel rally any further, or everything priced in? Yeah, so I think there's a lot of hype that's priced into Intel. Their current valuations is about 100 times forward price to earnings. I think this year itself, I am still seeing some catalysts for Intel. For example, Anthropic's IPO as well as OpenAI's IPO. So these are the catalysts that may drive Intel share price even further. And I think overall the backdrop is that US government took a stake in Intel, and I think especially the US president's close circle itself, I feel like they have quite a lot of ownership in Intel as well. So I think at least over the next 1 to 2 years, I feel that he's able to continue to broker some more deals for Intel, and this may drive further share price catalyst. I mean, this may act as further share price catalyst for Intel. Yeah, that's my feeling. But do note that if you invest in Intel, you are investing at a premium currently. Yeah. So that's the risk for Intel stock. Yeah. What's your take on Centurion expanding its Australia footprint? Yeah, so Centurion, they recently entered into the key worker accommodation. I think that iron ore segment is quite a key contributor to Australia's GDP. It contributes about 5% to Australia's GDP, and that particular area itself is highly concentrated iron ore supplier in Australia, about the west coast itself. Yeah, so I feel like that key worker accommodation may do well. And Centurion has also recently announced they have acquired a new student. They are expanding the new student accommodation of about 200 beds. They are adding 200 more beds. I feel like based on Centurion's track record, we are able to how to say, like, we are confident in Centurion's track record, because previously, before this surge in demand in Australia PBSA, they have also entered into the market since 2016. So they have a very strong understanding of the forward investments that they are taking. So that's my take on their expansion plans. Yeah. Why semicon equipment very strong recently? Yeah, so I think there's a lot of capex being guided, for example, by hyperscalers, as well as TSMC and the foundries, Intel, increasing their capex guidance for increasing their capex guidance, and this capex guidance will ultimately flow to semicon equipment players. For example, ASML, Applied Material, Lam Research. Because for example, if you think about the entire semiconductor value chain, maybe there is 10 steps in the value chain itself. Then ASML, Applied Material, and Lam Research, they are monopolies in in one of the step itself. So without any one of the step, the the supply of the chips itself cannot work. So that's why they are so key in the entire supply chain itself. And that's why their share prices have also reflected that. Yeah. Can I rank the top 3 counters I would invest in construction sector? Yeah, I think the top counter I would recommend is WeHer. I think that right now their share price is compressed because investors are looking ahead of whether the Tuasville dormitory lease can be extended in November itself. It will technically expire in November, but they are in talks with the government regulatory bodies to extend. And we are our base case is that extension will be granted to them because of the huge demand for the major construction projects and because this particular asset has 16,000 beds. So we think that the government wouldn't leave 16,000 migrant workers just stranded without any beds. And this particular asset is also compliant with the 2030 interim dormitory standards. So we do think that an extension can be granted for WeHer. Yeah, second most confident counter may be Everglory. I think that because of the major projects being tendered out already, for example, Changi Airport Terminal 5, MBS IR, the next phase of contracts being tendered out will be the M&E contracts, whereby the main contractors will tender out their mechanical and electrical contracts to the subcontractors. And we see one of the major beneficiaries as Everglory. Yeah. Maybe last but not least, I think I'll be quite confident in Pan United as well, because Pan United, following the past 2 years of very elevated contracts being awarded, I do think that this year and next year will be the cycle whereby Pan United will execute the contracts itself. So basically the main contractors will start to execute the projects being awarded, and because of this volume in project execution itself, Pan United will be a major beneficiary, especially because it has 40% market share in ready-mix concrete. Yeah, so that's my answer. Global Resource Construction looks like a good fundamental construction stock. Consistently getting contracts. Any thoughts? Yeah, I think you're right. A lot of their contracts come from the public sector as well. Like for example, HDB BTOs, civil engineering contracts. It's just that we haven't met their management, so I can't really give a very specific insight to the stock itself. Yeah, we have tried reaching out, but they did not get back to us. Yeah. Why WeHer share price weak despite the news recently? Yeah, so the recent news, thanks for asking, is they are expanding into Hong Kong PBSA. So there's 2 assets. One asset is that they will it's under a master lease structure. So they will lease from the landlord itself and they will rent it out and collect rental arbitrage. The other asset, the other Hong Kong PBSA asset that they acquired is a commercial property. So they will restructure the entire property and turn it into a PBSA itself. So that one is a longer term time frame until 2028. The first one, the master lease structure is expected to come up the second half of this year. But I feel that the price may be weak because there's still uncertainty. I think investors may not like this kind of uncertainty, especially when WeHer has entered into a new Hong Kong market. But I feel based on their track record in handling PBSA, I think they will do well. And also Hong Kong PBSA, I mean Hong Kong, they are trying to set up their country as a financial hub, especially after the 2019 riots, and there's a lot of brain drain from Hong Kong after the 2019 extradition bill. Yeah, so now we are starting to see the talents coming back to Hong Kong, and they also have like 5 universities under the QS top 100 university rankings. So that's why WeHer management is seeing this trend. Yeah. Okay, I think I hand over the time to my other colleagues. Yeah, I'll type the rest. Thanks.
Thanks, Wen. So let me take up some few questions. Sorry. Yeah. First is on Microsoft. So Microsoft walked away from a deal to lease cloud infrastructure to Oracle. So how does
Fahmi,
it
your
impact?
camera is closed.
Sorry. Sorry, everybody. Thank you, Ben. So Microsoft walked away from a deal to lease cloud infrastructure to Oracle. How does it impact these two companies? So the deal is not that material. It is only a $3 billion deal. So it is small compared to relative to these two large companies on how they operate. The scale is just small. I do think that this is more on the buzz. It's like the headline news make it seems big because it involves two powerhouse names, Oracle and Microsoft. So it's not really not that big, I guess, because for Microsoft, the impact it highlighted the shortages of the cloud, but this is not new. The Microsoft will continue to search for any cloud provider that they could get, NeoCloud or other hyperscalers such as Amazon. And then the ramping up of Maya AI chip is likely to increase workload efficiency, hence would probably reduce the need for cloud computing. And then for Oracle, the impact, losing the leasing of $300 billion deal isn't not that material. It's only 0.5% of the current backlog that Oracle currently have. More important is on this target project, which is their open AI workload, which is currently progressing and tracking as scheduled, and which we may see the accretive effect on the revenue in 2027. So it's not that material for both company. For Adobe, what's the impact of Shantanu Narayan's departure, which is the CEO, on Adobe strategy and execution? Not a concern. He will remain as the company's board chair after his transition out from the CEO. And he would also have the new CEO when he comes in, as what he said, that's what his predecessor did with him. So he would continue to guide him. So the company will still benefit from his input and direction because he still remains as a chair. So it's not much of a concern for us. So next question is, how does Adobe plan to compete with the AI narrative company, which is affecting its share price? And what is your view of their ability to maintain market share? For the market share, we do think that they are currently holding the majority of the market. Their products, which is for creative and also the PDF, are the industry standards. And switching out would involve high and quite expensive. And they are already deeply embedded in the professional workflow. How they would compete with the AI native? Well, most of all, they are large and then they are commercially safe models and intellectual property that are protecting enterprises from the copyright risk instead of using it from the open source. Their Firefly model, which is the AI models, are trained on a licensed Adobe stock, like a stock keeping unit and content, hence make it IP safe source. And also how they would remain competitive is that these enterprises normally would require multi-channel marketing equipment rather than just single marketing products. And then not to mention they already integrated many LLMs and third-party AI models into their own Firefly models. And then and also we are seeing today monetization model is what we highlighted in 3 minutes. A user migrating to higher tier product, their AI entry point product, which is Firefly and AI Acrobat, and also not to mention the generative credit usage, which is the more users use AI models, the more they would buy the add-on credit packs, which is contribute to revenue. We don't think that the AI revenue is growing fast because the product is already embedded with the artificial intelligence and the usage is already grown exponentially. But the AI revenue is only expected for us is expected to be accretive for the next 1 to 2 years. You don't see the impact like very quickly. So unless the headline figures such as the total annualized recurring revenue, which is a ARR pickup, we don't expect the share price, to rally anytime soon. So this is not your usual hypergrowth software companies. It's really just they're focusing on the traction first rather than ARR, which is not what the market like. So that is all from
Yeah. Let me take on some really quickly before handing over to Zane for the TA. Yeah, what is you create doing price placement? Yeah, so they are doing because they acquired 5 properties and converting the Lindsay House into a PBSA. Yeah, so that one I will leave it to Hashim to give more details. Hi, from the AIMS APEC REIT webinar is a low leverage but high amount of perps. Are there other REITs in similar situation that we should concern of? Yeah, so for AIMS APEC REIT, basically they issued so many perps this year is mainly because to refinance the existing perp that is at a higher rate. So now the existing perp is at a 5.375, which the first reset or call date is September 2026. So earlier this year in Jan, they issued 150 million, and in March they issued another 100 million, so 250 million. So the one that is expiring in September 2020, I mean not expiring, the first reset or call date is 250 million. So they basically the intention is to reissue the 250 million. So they did it earlier this year to so-called capitalize on the cheaper financing rate of about 4.1 and 4.25. So overall, once they do this swap, they'll be getting a 1% lower interest rate or coupon rate for the cost, 1% lower cost. So there is some overlap, but until September before they recall. But once they recall it, the previous perp in September, then the AIMS APEC REIT will have 250 million perps remaining. Yeah, but currently they have 500 million. Yeah, so are there any other REITs similar situation that we should be concerned? Yeah, so I don't think this really should be a cause for concern. And there are, if I remember correctly, Class did something similar, yeah, but it's not really a cause of concern because they are actually capitalizing on lower perps to issuing lower rate perps and to so-called refinance the existing perp which will be recalled. Yeah, so hope that answers that. What do you expect for blue chip REITs for rest of 2026 hold or add? Yeah, so for REITs, for blue chip REITs, we are more of a hold, especially the blue chip REITs. So you're getting a yield of around 5-6%. We don't think in this environment where we do expect some possible interest rate hikes. So it is unlikely that we can see a sharp movement in the share prices. So yeah, that is always the case also for REITs. We don't really expect much price appreciation after all, as they are more of a dividend yield play. So for us, yeah, we are more like I mentioned, we in my presentation we focus more on the higher yielding REITs. Yes, we think there is more value there. Any update on Manulife ES REIT? Yeah, so no recent update. Yeah, but once they sell Figura, they have hit their disposition target of 228 million. So from that, they have plans to reposition the portfolio into other assets like industrial, retail, and multifamily. Yeah, so there's no update since we last gave an update on Manulife. Yeah, so their goal is definitely to still bring the gearing to below 50%. As now it's still, if I remember correctly off the top of my head, is 56%. So they're still in the breach situation. Yeah. Just go trading at 37% below IPO price. Do you foresee further downside? What's the fair value price? Yeah, so we don't cover. We did a flip on the ground last or 2 weeks ago. Yeah, so if we foresee further downside, I think that we'll leave that to Zane to do the TA. But yeah, we do have a fair value price for Justco as we don't cover them. Any reason why class has been moving up given tourism improving globally? Yeah, class has not been moving up. Yeah, so for class, the share price has been relatively flat, so around 90 cents. But at this price, you're getting a yield of about 6.7% because they've already indicated that they will fix the dividends at 6.1 cents this year. They'll use previous divestment gains to top up. So currently they still have 300 over million divestment gains are sitting on the books. So they'll use that to top up DPU if there is any shortfall. But generally, we see for the first or over the past few months since the Iran war, the global travel has slowed down, especially from rising airfares and lower demand and more global uncertainty. So we have seen hospitality slow down a little bit. And the numbers we saw in Singapore was actually quite in May was down 10% year on year. So that was quite a big decline. With Fed keeping interest rates unchanged and even increasing to curb inflation, who will be winners losers within Singapore REIT sectors? Yeah, so for us, we believe the direct impact of if Fed raises interest rate definitely will be those with USD denominated loans, and we have to see how much basically they have hedged. But at the same time, these US players, a lot of their share prices has already been hit quite significantly, and they are trading at very steep discounts. And like for example, Prime and UH REIT, they are trading at high yield, so we think that is attractive. But there is some slight pressures. Within the Singapore REIT sector, but generally the Singapore side, we are still seeing the SORA still remaining low. It is creeping up slightly, but it's still under 1.1, so that is over 110 basis points lower year on year. So there is still we still do expect interest cost savings. And on top of that, the Fed also, if you look year on year, the Fed fund rate is also lower year on year, and there is some potential savings from that as well. Yeah, but like Iqbal mentioned earlier, we are expecting our house view is that there'll be no rate hikes this year. Yeah. Hi, what's the rough timeline to StoneX's potential fair value adjustment? Yeah, so this is will be in phases. So most recently they just finished the phase 1 and they signed a lease. So I believe that lease commenced. So as they continue developing and as they sign more fixed leases and as they develop, so then the fair value adjustments will come in. So we are expecting incremental fair value adjustments every year from this development as the portfolio gets developed and as they start leasing up the portfolio. We look at Japan on a hiking path. How will this affect Boston REITs DPU payout since this REIT has assets in Japan and carries yen denominated loans? Yeah, so definitely they were impacted by the rising rate. But for Boston REIT, they have indicated that most of their Japanese yen will be hedged, so the impact will not really be significant. Yeah, it definitely will be impacted, but it will be more minimum as I believe over 80% of their Japanese yen, which accounts for about half of the portfolio, has been already hedged onto fixed rate. Yeah, so this 35 basis points will have limited impact. How will a rate hike by FOMC affect NTDC REIT? Yeah, so NTDC REIT, their fixed rate loans are on 70%. So any rate hikes definitely will affect the distributor income and DPU payout for NTDC REIT. But for NTDC REIT, we believe there is a strong case for rental growth as data center. The assets have shown very strong rental reversions. We still think there is potential for more. So that's our take for NTDC. But if there are potential rate hikes, NTT they will be impacted because they still have that 30% that are on floating. There are still many questions. I think either hand over to Hashim or Zain to do the TA for the last 10 minutes. Yeah, thanks. I'll type in the other questions.
Zain, I think you can go ahead. I will type the answers to the questions.
Wait, thanks. I will go ahead with the EA. So let me just share my screen. Yeah, so first question, I think on Frank, I think overall chart has been a bit more positive recently. So last week, the price broke above this short-term downwards resistance line over here, and then did this consolidation over here as well. Trending above some of the short-term moving averages of 5 to 20 SMA levels. And today, I think with the price did quite well to test this $3.32 level. So I think over here you might see some slight resistance, but I think overall I think there's still a good chance of price trying to trend higher and retest the previous high over here at 352. Yeah, as long as the price still remains along the 5 SMA currently, like around 315. I think this will be this recent breakout, like above 320 will be the new support level for now. Overall, I think still looking more positive. In terms of weekly chart, I think it's also holding quite well, at least along the 10 SMA level as well. And yeah, price pulled back quite a bit recently and then found support over there and continue to rebound. So I think it's looking positive. Next one for sets, I think it's also quite bullish price action as well. Yeah, so for sets, I think overall price continue to rally after a period of this bullish trend consolidation on low volume, and the volume picked up again. We could break above this $4.04 level. So I think with that price, I think we're still likely to see this uptrend continue, I think, for at least in the short term. I think next resistance level will be around 445 over there. And then potentially next one is at 465 next key level. I think short-term support could likely come from the 5 SMA level as well as this lower week on Friday, which was 428. So I think that's a short-term support level. Next one on 778, Fortune REIT Hong Kong. So I think for Fortune REIT, price action not so good. Previously was previously was trending upwards, but I think that trend has kind of changed since about May this year. So price actually couldn't hold this $5.05 breakout level. Afterwards, subsequently, a retest became resistance. And then afterwards, you're seeing continued share price will break down below this support like 466, lower highs along the way. So lower low rebounds. Yeah. So I think overall, we could still see some weakness. Next key support is quite near around this 448, 450 level. Price might do some temporary bounce from there, but I think key resistance will likely still hold at around 460 to 466 for now. Yeah, then the next support below that I think could be around closer to 440. Yeah, where there's this another trend line support over there. So that's my take on Fortune REIT. Next one on some US counters. First one, NVIDIA. I think for NVIDIA last week did some consolidation in this resistance. So retest of this resistance, there was a bit of a pullback, but found support is around this gap fill and this horizontal level around 205. So I'll just sideways. I think for this week wise, we still see a bit of sideways as well. Still the resistance, I think still see some resistance at 212, 213. Above that, I think the next key resistance is about 219, 221 area. Okay. Then support, I think will likely still hold around like 205 to 208 around. So could be still a bit more sideways in the short term. Next one for Broadcom, I think there was a bit of a rebound towards the end of last week. So price kind of did sideways and then managed to break above this with a gap up on Thursday above this 395 level. So currently close to a 20 SMA level. So I think this level at around 415, it could be some short-term resistance, which is the 10 SMA and the weekly as well. So this is the 20 SMA daily as well. So could be some short-term resistance of 415 to about 426 over here. And then I think if there's a pullback, I think support will be found at the last week's levels, around that closer to 390 to 400 this year. So I think will be a bit sideways as well. Yeah, but I think short-term wise, I think price will form a whole bit of a higher low with a breakout of these 5 and 10 SMA levels following the pullback of the results. Next one on Visa, I think share price likely to be quite sideways, I think. In terms of the Bollinger Bands, I think it's quite flattish. And then currently a bit of a pullback from the upper end, which is around 334, and then this horizontal resistance level as well. So I think most likely we will see some pullback. I think some short-term support could be found at 324, 325, this horizontal level, where the 10, 20 SMA level are as well. So price could do a bit of a bounce over here, but I think overall the strong support is closer to about 319 rounding, where there's horizontal level and closer to the lower band. So I think general trend should be a bit sideways in the short term. Next one on Johnson & Johnson J&J, also kind of sideways in short term. Some price weakness with some breakdowns towards the end of the last week. So price was below this 234 level again, and then Friday is below this 231. So I think we might see some short-term weakness, I think, to perhaps retest closer to this support area again, like closer to 222, 223 slowly. And then resistance would be 231 to 235 in the short term. So we could see some short-term weakness following the price failing to hold above 234. And then also generally still a bit of like lower highs since the pullback as well, lower highs and lower lows. Next one on Eli Lilly, I think we could possibly see some short-term price weakness. I think for the price, it failed to hold above this like 1,100 level. Those are like a high being formed, but I think there's some bearish divergence in terms of the RSI, and then some short-terms and then some short-term weakness was when the price this red line over here is the 10 SMA level, previously was holding as a dynamic support. And then towards the end of the week, I think there was some breakdown. So if price cannot recover above this 1,130s and above, I think possibly we could see some continued weakness if it breaks below like the Thursday lows. So next key support, I think it could possibly retest this 1,050 swing low again, then might do a bit of a bounce. The next one, there's a question on the TA for WeHer. Yeah, for WeHer, I think generally still a bit weak in terms of the trend since the breakdown, the recent breakdown over here, 71 cents. Price consolidated sideways and then failed to hold the range and then back to retest this support at around 63 to 64 cents rebound. And over here, this consolidation area, there was some resistance. So I think overall, I think this 68 cents to about 70 cents area will likely still hold as resistance, where I think it's around the upper Bollinger Band area as well. But support, I think, should be the recent levels. There's some support over here at 65.5 cents. Afterwards, if it fails over, then we'll be back towards 63 to 64 cents. So generally, I think will be pretty sideways in the short term. Yeah. Next one for CDL as well as Hong Kong Land. For CDL, I think general trend price has been still quite range bound since the pullback from end of February. Key resistance still has not been broken at 860. And then key support area is at 780 to 810. So if price is currently at around this 810 level, if it breaks down below that, I think we could see some further price moves towards 780 again. So I think it's still generally in this range over here. And for Hong Kong land, I think we've also seen there was a breakdown of this range around that 747, 770 support level. That has turned to a resistance and price still making lower and lower lows. For now, so there could be some support over here around $7. There was this previously this range area in December last year. So there could be some bounce over here, but I will still expect some resistance for now at 720 and above. So I think could be just a bit of sideways movement. Then if price fails to hold this level, we might see some continue pull back towards 680 as the next support. Okay, I think it's about one. So I think there's still quite a bit of questions in the Q&A that we are unable to answer. So as apologies for that. I think but feel free to post all your questions that you have in our poetry community, and then we will take it over there. So I think on behalf of my team, I'd like to thank everyone for your attendance in today's session, also for all your questions. And we hope to see you again next week. Have a good week ahead. Bye bye.